You're gonna like this.
I don't care about your opinion when I'm right. Today I'm looking at the risk part of where people will flee if the market crashes. I keep wanting to point at the screens, but I realize I'll use the cursor here. People think and have said to me that they feel that the 10-year being at its high has very limited risk. And what I think I have a need to point out is they don't understand the risk in the 10-year bonds. I happen to be short the 10 years, but I have various forms of protection in place, ratios, and I'm long the 5 and options. And if the stock market crashes, there will be a flight to quality, and people will in fact buy the 10 years and maybe the 5s and the 30s for sure, like they did in '08. But what people need to be cognizant of on this chart, unfortunately, on this left axis, these are the interest rates, but the decimal is off. I didn't make TradeStation, so it's not my fault. So please notice in 2011, the low yield on the 10-year. Now back in '09, you could see the 10-year got down to nearly breaking 2%. And I keep wanting to point again, but recently, during the middle of the QEs and twists and various stupid things, the 10-year got down to about 170. Now we see that the price on the right axis is 131 plus nearly 132 as the all-time high for the 10-year. Now keep in mind that they're inverted, price and yield. So you can see yield down, price up for people that don't trade bonds. The issue that I have is if we go down and take out here this 170 area or go in a market meltdown potentially lower, I could see the 10-year yield at that giving us a price somewhere towards as high as 138. I've run all kinds of calculators, empirical duration tools and things to that end that the CME provides, and I find them to be not exactly as accurate as I would like. So I'm pointing out that this little box of risk is bigger than you may think. So just because you're on the continuous contract and see the 10-year or the 30-year at its high, recognize there is more risk to it than you think. So if you're short the bonds, you need to have some sort of a big negative delta trade. You need to be long front month of all, or some puts on the S&P or something to that effect. And as you study this chart, you can see I put the S&P on a weekly down here too. So they had coupled and then decoupled yield and price. So this might not be as interesting at the girl at the beginning, but I'm trying to provide some risk management to people in probably my favorite trade, which is short the 10 years, but hedged.